Hello everyone, my name is Radna CEO and Head of Research at Quantpedia. Topic of today's video will be pragmatic asset allocation. We will discuss one particular model. This model is built by us in Quantpedia, and I will show you a few reports that are related to this model, and I will show you, if you pick any model in Quantpedia, how you can run some analysis of that model, how that model perform over various market cycles, etc., etc. So, let's get to it. So the whole video is based on our blog. It's called Pragmatic Asset Allocation Across Market Cycles. It was published approximately a week ago. What is pragmatic asset allocation? So it's a systematic multi-asset investment strategy. It's a tactical asset allocation strategy. So its goal is to adapt to evolving market conditions. So the strategy allocates capital among a diversified set of asset classes. So there are equities, bonds, commodities, golds, and cash-like or cash instruments, and we are using momentum and yield curve signals to rebalance between those assets.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports, and save hours of work. Quantpedia Pro, your edge in quantitative investing.
The whole methodology is in independent article, so if you are interested, you can go through the whole article. I will not go into detail. There is even the video on our web about this model, or you can read the article. Basically, we are using the momentum, we are picking the best performing asset, and if the risky assets are too risky, or in a drawdown, or in a bear market, we are buying the hedge portfolio that consists of either 10-year treasury bonds or gold. And there is a whole methodology how to do that, how the trenching work, etc., etc. So I will leave that up to you. If you are interested, you can read it. This is how the model looks like. It outperforms the market relatively nicely. Our benchmark is not S&P 500, our benchmark MSCI World stocks. So all of the stocks all around the world. The reason for that is because we are moving in and out from the US also. So we are not holding just the US stocks. This is how it does look like. We have a dedicated report for the whole model. So you can go to portfolio analysis section in Quantpedia. So here in the product and here in portfolio analysis. And on the left side where there are essential reports, you have a report called pragmatic asset allocation. So if you click on this report or here on this button, your report will open. And what is the report showing? So first it shows what is the actual performance compared to the benchmark. It is showing the actual drawdown. You can see that we are close to all-time high. It's showing the performance table, and it's showing the portfolio composition over the last 10 quarters. So the model is rebalanced on a quarterly basis, so we can see what were the assets that were in the portfolio in the past. So we see that we had high allocation in the gold in the past, we had a high allocation in the cash, then we moved into the treasuries, and in the last few quarters we are moving into the stocks. That's how the portfolio composition look like. And we have also the portfolio composition over the last 3 months and future 2 months. This part of the report will show you how you can allocate on a monthly basis. So if you would like to follow this report, you can see that until the end of the January, this was your portfolio. So you had some part of the gold, some cash, so 12.5% of the gold, 12.5% of the cash, and the rest of the portfolio was allocated into MSCI World stocks, some tech stocks, and some emerging market. From February 2026, we moved more into the stocks themselves. So this is how the portfolio look like. You have also the allocations in the table form. And you can check the portfolio composition. We can review the performance of the model over the 2023 to 2025, or let's say 2025. So here is the performance of the model itself in 2025 when you compare it to the benchmark. You can see that we outperformed in 2025 very easily. The reason for that was because our portfolio had a lot of the gold. So once again, we can take a look on the model itself, and we can see that in 2025, a significant part of the portfolio, around 50% of the portfolio, was in the gold, and we were selling the gold as the year progressed. So we were getting out of the gold, and right now we do not have any gold in the portfolio. Why this so? We will get later to that. And here is the forward-looking portfolio allocation, so we can see. So why we are moving out of the gold, why we are moving to the equities. So we can check that in the equity market phases report, how the equity market phases report works. So you can pick any model into your model portfolio. So in this case, I picked that pragmatic asset allocation model, and you can run the equity market phases analysis report. That equity market phases analysis report is here among the risk management reports. So you can can click here and you will get this kind of report. What is this report doing? So it takes the equity market, it divides the phases of the equity market into 4 parts. So we have a bull market, we have a correction, we have a bear market, and we have a recovery. So bull market is when both long and short-term momentum of the equities are positive. Correction is when the long-term momentum is positive but short-term momentum is flipped to negative. Bear market is when both long and short-term momentum are negative, and recovery is when we have a long-term momentum negative, but short-term momentum already flipped to positive. So this is how we can define what is the current market phase in the equity market. And we can check out what is the current equity market phase, and we can see that at the moment we are in the bull market. We are nearing the top of the bull market, but we are still in the bull market. So, and when we are in the bull market, it makes sense to hold more equity. So that's the reason why pragmatic asset allocation model switches the quarter after quarter after quarter, and right now in this quarter into the stocks. Once we switch into the correction, or we will go into the bear market, and we will get out of the equities. But at the moment, it still makes sense to hold the equities. Here we can see what is the performance of the model compared to the S&P 500 in different phases. So we can see that in the bull market, the model is not performing as strongly on a monthly basis, so 1 month performance, as SPI itself. However, we do not need to be afraid moving into the equities at the moment, even that we are close to the top, because in the correction, the model is not losing so much money as the market, and also in the bear market, the model is not losing so much money. So we can allow ourselves to hold the equities because the model switch itself off when the bear market will come. So we do not need to be afraid to hold equities in the next quarter. But this is how does it look like when we do the equity market phases analysis. And you can pick any model or any portfolio, and you can analyze the individual phases of the market in this report. So let's move on. So this is this part of the article, and we can evaluate the model even more. So we can evaluate the resilience of the model under extreme conditions. So we can take the model and we can run the report called 1-day shocks and 100 years historical events report. This is one more. This report is among the essential reports. And how does it work? So it will take your model portfolio and it will run the special calculation, so the special methodology, and it will create 100 years of synthetic portfolio based on your model portfolio. Then we can use the last 100 years and all of the crises over the last 100 years to check how would your model portfolio work in those crises. And you can compare that to the equities. On the left side, you can see the equities, how volatile they are after there is a shock in the market. So shock is defined as a very strong down day in the market, and you can see how the equities are performing. So there is a very strong volatility and a lot of the uncertainty after the shock in the market. And on the right side, you can see how the model is performing. So when there is a shock in the market, the model will lose some money, but the overall performance is better than the performance of the equities themselves after the shock. And you can compare to the shocks in the bond market. You can compare, how the model or any model portfolio that you picked here in this part will perform when there is a shock in commodities. You have also the tables, and you can also check out how the model performs when there are the wars compared to the equities. So on the left side, there are some of the most important wars over the last 100 years. So there is Second World War, there is war in Korea, there is an Iraq invasion of Kuwait, Suez War, Pearl Harbor attack, etc., like most important wars in the past. And on the right side, you can see after there is a shock, how the model is performing. And once again, we can see that the model is not so risky as the equity market itself. So we do not need to be afraid to buy more equities into the model, because if there will be the shock in the future, the model will decrease the equity part of the strategy itself. There are more things in the report. You can check the political crisis, you can check the president-related events in the equities, and how does it look like when you have the model. This is, really a risk management report. You can really pick any model from which we have, or you can pick your own portfolio. I can run this report. I will probably end here. So I hope that you liked this video. I showed you multiple reports, especially in this case risk management reports. I picked one model and I showed you how you can run the historical analysis, how you can run the crisis analysis of that model. In this case, it was our pragmatic asset allocation, and I tried to explain to you how this model works and how it changes the allocation over the time, and how was the allocation looking over the year 2025. If you like this video, please subscribe to our channel, give us a like. Feel free to check out the other videos where we discuss quantitative trading, algorithmic trading strategies, quantitative finance, etc. So thank you very much for your attention.